Now moving to the last question in the exercise of chapter 9. It is a question regarding the international transfer pricing. You can read the question. Pause the video and read the question. Okay, now what is given in the question? Standard Corporation Incorporated is SCI is a US based multinational company engaged in manufacturing and marketing of printers and scanners. So there is a company which is referred as SCI. It is a US based company. US based company. And what does this company do? It is engaged in manufacturing of printers, manufacturing and marketing of printers and scanners. Marketing of printers and scanners. Okay, now this company has subsidiaries spread around across the world, and which either manufactures or sell printers and scanners using the brand name SCI. Okay, so it has got subsidiaries all throughout the world, and some of the subsidiaries may be either manufacturing certain parts or manufacturing the printers or scanners, or some subsidiaries may be marketing it. Okay, so everything related to printers and scanners. Okay, and they have subsidiaries across the world. Now we are going to talk about two subsidiaries. One is the Indian subsidiary of SCI buys an important component for the printers and scanners from the Chinese subsidiary of the same MNC group. So there is Indian subsidiary and there is Chinese subsidiary. And what do they say? Indian subsidiary buy an important component for printers and scanners from the Chinese subsidiary. Okay, so this is manufacturing. Manufacturing a component. Manufacturing a component for printers and scanners. Printers and scanners. And what does Indian subsidiary do? Indian subsidiary buy that the component from the Chinese subsidiary. Okay, and number of units required is 1,50,000. Okay, the Indian subsidiary buys 1,50,000 units of components per annum from its Chinese subsidiary at a rate. What is the rate? CNY. Okay, let us call it as Chinese yuan 30 per unit. Chinese yuan. It is Chinese yuan 30 per unit, and pays a total customs duty of 29.5% of the value of the components purchased. So this plus 29.5% of value as customs duty. Okay, so this customs duty is paid in India. So this 29.5 has to be applied on which value? The Indian equivalent, Indian rupee equivalent of the Chinese yuan 30. Got it? Okay, now going further. What is given in the question? A Japanese MNC which manufactures the same component which is used in the printer and scanners of SCI has a manufacturing unit in India and is ready to supply the same component to the Indian subsidiary of SCI at rupees 320 per unit. Yes. So there is a Japanese company. There is a Japanese company, and this Japanese company has a unit in India. And what does this unit in Indian unit does? This Indian unit is manufacturing the same component. Manufacturing. I'm writing it as the required component. Okay, or the component that is required by the Indian subsidiary is being manufactured by the unit of Japanese MNC in India. So naturally they are ready to give this at a rate of rupees 320 per unit. Okay, so now Indian subsidiary has got two options. Option number one, continue buying from, continue to buy from Chinese subsidiary. Okay, and there is another option, option 2. What is option 2? Buy from the Japanese unit. Is it clear? So these are the two options that the Indian subsidiary has. Now SCI is examining the proposal SCI is examining the proposal of the Japanese manufacturer and has asked its Chinese subsidiary to present its views on this issue. Okay, why the SCI? SCI means the SCI in US. Why the US company is examining this proposal? Because the company feels that the rate at which this particular component is made available in India may be at a lower rate or at a cheaper rate than the rate at which it is supplied by the Chinese subsidiary. Okay, so but since it is an internal transaction, they want to know what is the view of the the Chinese subsidiary. Okay, so the company has asked the views of Chinese subsidiary before they take a final view on this. Okay, so the US company, the parent company, has asked for the views of the Chinese subsidiary with respect to the proposal received by the Indian subsidiary from the Japanese MNC or Japanese unit. Okay, now what does the Chinese subsidiary inform? The Chinese subsidiary of SCI has informed that it will be able to sell 1,20,000 units of the components to the local Chinese manufacturers at the same price, that is 30 yuan per unit, but it will incur an inland taxes at the rate of 10% on sales value. Yes. So what does the Chinese subsidiary say? Chinese subsidiary has two options. Okay, Chinese subsidiary has two options. Option 1, continue transferring 1,50,000 units to India. Okay, and there is no other cost for the Chinese subsidiary. Now option 2, if option 1 does not work, then it can sell 1,20,000 units in Chinese local market. Okay, at Chinese yuan 30 per unit. Am I right? 30 per unit. But there will be an inland tax. But there is an inland tax at the rate of 10% of sales value. of the sales value. Okay, so these are the two options. So here also it is transferred at rupees 30 per unit itself. Okay, so these are the two options that the Chinese subsidiary has. Now going further, what does the question say? Variable cost per unit of manufacturing the component is 20 per unit. Fixed cost of subsidiaries will remain unchanged. So the variable cost of manufacture, how much? It is 20 per unit. Okay, so this is the information that is made available by the Chinese subsidiary. Now you have the corporation tax rates, Then corporation tax rates and currency exchange rates are as follows. China, the rate is 25, India 34, and USA 40%. Then currency exchange rates, US dollar, that is 1 US dollar is equal to rupees 61.50, 1 US dollar is equal to Chinese yuan 6.25, and 1 Chinese yuan is equal to 9.80 Indian rupee. Now, what is the requirement? Prepare a financial appraisal for the impact of the proposal by the Japanese manufacturer to supply components for printers and scanners to Indian subsidiary of SCI. Present your solution in Indian currency and equivalent. Identify other issues that would be considered by SCI in relation to this proposal. So, here the question is impact of the proposal by the Japanese manufacturer to supply the components for printers and scanners to Indian subsidiary. So, the financial impact of proposal should be presented from the perspective of Indian subsidiary, then Chinese subsidiary, then company as a whole. Is it clear? And you should also identify the other issues that needs to be considered. Okay, fine. Now, how to do that? First, you will have to prepare a financial appraisal. Okay. Appraisal of the proposed plan. Okay. So, under that you can write, what is the proposed plan? Proposed plan is 1. Indian subsidiary to buy 1,50,000 units of component from Japanese local unit in India at rupees, what is the rate? 320 per unit. Okay, that is one aspect of the proposal. And second aspect, what will happen to the Chinese subsidiary? The Chinese subsidiary to sell 1,20,000 units of the component in the local Chinese market. Okay, so here what you have to notice is, if this Chinese subsidiary is transferring the goods to Indian subsidiary, it can sell how many units? 1,50,000 units. Okay, on the other hand, if this internal transfer is not happening, then and the Chinese subsidiary is forced to sell the goods in the Chinese market, then it can sell only how many units? 1,20,000 units. And also, for Indian transfer, there is no other cost for the Chinese subsidiary. Okay, there is no tax for the Chinese subsidiary. But Indian subsidiary has what tax? Customs duty is payable at the Indian subsidiary level. Okay, but Chinese company or Chinese subsidiary is completely free. But when they go for the internal or domestic sales, that is the sale of 1,20,000 units, there are two aspects. One is sales lost to the extent of 30,000 units. How sales are lost? Because if there was internal transfer, they could have sold 1,50,000 units. I mean internal transfer. But now in the domestic market, the demand is only 1,20,000 units, and they can sell only 1,20,000 units. That is one. Second, there is tax at the rate 10% of sales value. Okay, there is 10% on the sales value. So these are the two things which needs to be considered. Okay, now financial appraisal, you can write okay, financial impact of the proposal, that A, on the Indian subsidiary. Indian subsidiary. Okay, what would be the cost details? When Indian subsidiary buy the product from the Chinese subsidiary, what will be the cost, and what is the cost when it is purchasing the goods from the Japanese unit in India? Okay, the difference will be the savings or additional cost on account of this proposal. Okay, so you can write cost of purchase from Chinese subsidiary, amount payable to Chinese subsidiary. It will be 1,50,000 units into, what is the rate? 30 per unit. And what is the exchange rate? Exchange rate is given to be, what is exchange rate? 9.80 rupees, 9.80 per yuan. Okay, that is equal to 1,50,000 into 30 into 9.8 will be 4 crore 41 lakhs. Okay, then add, what should be added? Customs duty, because when they import the goods from the Chinese subsidiary, they need to pay the customs duty. At 29.5%. In bracket you can write on INR equivalent. This rate of 29.5% have to be applied not on the Chinese yuan, it should be applied on the Indian equivalent. So 4,41,000 into 29.5, 29.5, it will be 130,09,500. So total cost of purchase will be 441 plus 130,09,500. So it will be 571,09,500. This is A. Okay, now next, cost of purchase from Indian unit of Japanese MNC. Japanese company. How much? 1,50,000 units into 320. 1,50,000 into 320, that is 4 crore 80 lakhs. So what happens is, if Indian subsidiary is going to import the goods from the Chinese subsidiary, they are going to pay a total of 571,09,500, whereas if they are purchasing it from Indian unit of the Japanese MNC, they need to pay only 480 lakhs. So savings in purchase cost. Savings in purchase cost is the difference. So 579,05,500 minus, okay, difference will be 91,09,500. 91,09,500, that is the savings. Now there is a problem. When there is cost, there is savings in cost, there will be additional tax payable. The income of Indian subsidiary will increase to that extent. So Indian subsidiary will have to pay tax in India. And what is the tax rate? It is, what is the tax rate? 34%. So less additional tax impact due to savings in cost. Okay, in 2.34, that will be 30,97,230. Okay, so net after tax savings or savings after tax, after tax to the Indian subsidiary, how much? 9109,500, 9109,500 minus 3097,230. So 60,12,270 is the savings after tax to the Indian subsidiary. Okay, so you can conclude, therefore the Indian subsidiary will have a net saving of rupees 60,12,270, 60,12,270 rupees by purchasing the component from the local unit of Japanese MNC. Okay, so that is the benefit to the Indian subsidiary. Now you have to see what is the impact on the Chinese subsidiary. Okay, so financial as far as Chinese subsidiary is concerned, in order to compute what is the impact, you have to see what is the income, net revenue to the Chinese subsidiary on account of internal transfer and on account of external sales. Okay, so revenue on internal transfer, 1,50,000 units into, okay, into yen. How much yen? 30 into rupees 9.80 per yen. So that will be 1,50,000 into 30 into 9.8 will be 441 lakhs. Okay, and there is no other taxes on this. Whatever the Indian subsidiary is paying, that is going to be an income of this company. Okay, now what do you have to do? Revenue on external sales. If there are no internal transfer, revenue, the company can sell only 1,20,000 units. So 1,20,000 units into, okay, they say that there is tax, so but then we will take gross revenue, that is 30 into 9.80 rupees per this one, that will be 1,20,000 into 30 into 9.8, that will be 352.18. Okay, then what do you have to do? less taxes payable. Okay, local taxes payable at, what is the local taxes payable? It will be 10%. Okay, so 1,20,000 1,20,000 into 30 into 10% into 9.8, that will be 35,28,000. Therefore, net revenue from external sales 352,80,000 minus 35,28,000, that will give you 317,52,000. Therefore, loss of or decrease in revenue. Decrease in revenue means there is no change in the cost, because on one side they have to manufacture how much? Okay, so decrease in, they have to there is 1,20,000 on one side, there is 1,50,000. Okay, sorry, there is one change. You will have to find out, see, the number of units produced in the internal transfer, it was 1,50,000 units, whereas in case of internal external sales, you are selling only how many units? 1,20,000 units. So definitely you have what? Cost savings also, because you need to produce only 1,20,000 units and not 1,50,000 units. Okay, so what do you have to do? You have to first, you have to find out the fall in or reduction in revenue. Revenue will be 4,41,000 minus 317,52,000, that will be everything in rupees, 123,48,000. Okay, so this is reduction in gross revenue. Now what you have to do? There is reduction in expense also, cost also. Due to, why there is reduction in cost? Because in the case of internal transfer, you had to produce 1,50,000 units, but here you are producing only 1,20,000 units. So due to lower production, what is the reduction in production? 1,50,000 minus 1,20,000, that is 30,000 units, into what is the variable cost? The variable cost will be how much? Variable cost was given to be 20 into rupees 9.80 per year. So that is equal to 30,000 into 20 into 9.8, that will be 58,80,000. Therefore, net benefit or cost or loss to the Chinese company Okay, how do you do that? Fall in revenue, fall in gross revenue is 1,23,48,000. This is taken as a negative value. Okay, why negative? Because it is negative figure, because it is additional cost. Then plus there is cost savings to the extent of 58,80,000. Therefore net benefit will be 123,48,000 minus 58,80,000. It comes to, total comes to how much? 64,68,000. 64 lakh. Okay, net loss before tax. But when the revenue decreases, you have what? You have tax savings also. Okay, that also should be considered. So that will reduce the net loss. So less tax savings due to loss. And what is the tax savings in tax rate in China? China tax rate is 25%. So at the rate 25%, this will be 64,68,000 into 0.25, 16,17,000. So net loss after tax, $64,68,000 minus 16,17,000, that is 48,51,000. 48,51,000. Is it clear? Okay. Now that is the, so you can conclude the proposal to buy the component from the Indian unit of Japanese company. This company will reduce the profit or benefit of the Chinese company, Chinese subsidiary, by rupees 48,51,000. Is it clear? Now what you can do, you can find out what is the net impact on SCI group. Net impact on SCI group. Then savings to Indian subsidiary. What is the savings to Indian subsidiary? Indian subsidiary is saving 60 lakh 12,000, 16 lakh 12,270. Now less additional cost to or loss to Chinese subsidiary. $48,51,000. Therefore net benefit to SCI group 60,12,270 minus 48,51,000. It will be 11,61,270 net benefit. So what could be your conclusion? Your conclusion could be the proposal to buy the components from India will increase the profits of the SCI group by rupees 11 lakh 61,270. See, in the problem they say that you have to present the answers in Indian rupee. That is why we are providing it in Indian rupee. Otherwise you can convert it into US dollars also and present it as US dollars. Okay, fine. Now there is one more sub question. What is the next sub question? Identify other issues that would be considered by SCI in relations to this proposal. Okay, so other matters to be considered. Other matters to be considered. Point number 1. Okay, you have to see, now there is a proposal from Japanese manufacturer. Okay, now what you need to first see is whether this proposal from the Japanese manufacturer is for a short term or a long term. Okay, in other words, you have to consider the longevity of the proposal from Japanese manufacturer. Okay, so longevity of the proposal of the Japanese manufacturer. Okay, so you have to see whether the Japanese unit or Japanese manufacturer will be able to supply the components in the long term. Okay, so how do you ensure that they will supply you in for the long term? You have to enter into long term agreements. So you can write, if possible, try to enter into long term supply contracts. Is it clear? Okay, now the second point is, see, this is an international transaction. There is an international transaction when the goods are bought from Chinese subsidiary. That is number 1. And also, even though the present proposal is to buy from Japanese unit in India, there could be an impact on this, as this unit is a subsidiary of Japanese entity. Now tomorrow government comes out with a order which abstains all Japanese manufacturers from having manufacturing operations in India. What will happen to this unit? This unit will have to be shut down. Same thing may happen to the Chinese subsidiary also. So the fiscal policy in India will have a impact. So you can write impact of changes in Indian fiscal policy on both the options, both the alternatives. You have 2 alternatives, and the fiscal policy may be affecting both the alternatives. Okay, now next, see, ultimately when the profit is generated by the Indian subsidiary, from what should the parent company do? The parent company should be able to repatriate these profits to US, because the headquarters of, or the place of origin of this SCI is in US. Okay, it's a US based company. So it is only the Indian company is only a subsidiary, or Japan company is the Chinese company is only a subsidiary. So whenever this Japanese Chinese subsidiary or Indian subsidiary makes profits, the US company, parent company, should be able to take this profit out of India to US, or out of China to US. Okay, so the impact of repatriation guidelines to US. Okay, and also this may be subject to the impact of fiscal policy in China. So you have to consider all these factors before you take a final decision. Okay, now another aspect is quality of the product. See, when you are when you are getting this product from the Japanese Chinese subsidiary, you can be somewhat sure that you will get the required quality, because it is supplied by a Chinese subsidiary, which is your which is a section of your company itself. Okay. On the other hand, when you go for an external purchase, like Japanese companies subsidiary units in India is providing you the goods, quality could be a concern, so that has to be considered. So these are the major points other than the monetary aspects which you need to consider before you take a decision on this particular case. Okay, now I think with this entire chapter is over, and we have done almost all the questions from this chapter 9. Okay, so we are concluding with this, right?